where everything will start to make perfect sense. Look at another chart example. As you can see, the market dropped, then reversed, creating this support level. After pulling back, price reached the same support level again and formed a doji candlestick. In this case, the doji indicates a pause influenced by a possible reversal. So remember, the doji doesn't only represent a pause in the market, it can also serve as a reversal signal, especially when it appears at a key support or resistance level. And look at what happened next. The market moved up again, exactly as expected. Now, let's move to the next candlestick pattern, the tsutsumi. In Japanese, tsutsumi means to wrap or to engulf. To Muneisa Homa, this candle wasn't just a pattern, it was a message of dominance. When one candle completely covers the previous one, Homa saw it as a shift in power. The stronger side, buyers or sellers, had not only fought back but erased the previous session's emotion completely. He described it as, when one day swallows another, the market's heart has changed. In simple terms, a bullish engulfing forms after a decline. The green candle covers the body of the previous red candle, showing that buyers have taken full control. A bearish engulfing forms after a rally. The red candle swallows the previous green one, revealing that sellers have seized control. To Homa, the engulfing candle wasn't just about size, it was about emotion. It meant that one side's conviction had completely crushed the other's hesitation. He often combined the engulfing with key levels or after a doji to confirm reversals. What he called the market's confession. In modern price action, the engulfing pattern represents a clear shift in momentum, a signal that the market is changing direction or gaining strength. At the bottom of a downtrend, it indicates a bullish reversal, showing that buyers have absorbed all selling pressure and are ready to push the market higher. At the top of an uptrend, it signals a bearish reversal, revealing that sellers have stepped in and taken control. And when it appears in the middle of a trend, it often signals a continuation, confirming that the pullback is over and the trend is ready to resume. Homa's principle was simple. The market's past emotion is trapped inside the new candle. Now, let's move to the next candlestick pattern, the harami. In Japanese, harami means pregnant, symbolizing a smaller candle hidden within the body of the previous larger one. To Muneisa Homa, this pattern wasn't about pregnancy, of course. It was about containment. One day's price movement contained within another represented the market's hesitation before a decision. Homa saw the harami as a shift in volatility, the moment when the market's energy compresses. He wrote, "When the child rests within the mother's body, movement pauses, but strength is building." In simple terms, an inside bar appears when price trades within the high and low of the previous candle. It shows indecision and reduced volatility, but also potential energy. After a strong move up or down, the harami often signals that momentum is slowing and a reversal could be near. During an active trend, the same harami can act as a continuation pattern, a temporary pause before the next impulse in the same direction. Homa used this candle as an anticipation tool. When he saw a harami forming, he didn't rush. He waited for the market to break out of the mother candle's range. The direction of that breakout for him revealed the market's true intention. Let me now show you a real chart example. As you can see here, the market was trending down. Then it started to consolidate for a while, creating what we call a range-bound market. After some time, the market broke above the range, signaling a potential trend reversal. Right after that breakout, an inside bar formed. This candle represents a pause in the market, which is completely normal. After a breakout, traders are uncertain. No one knows yet whether this is a true breakout or a false one. Muneisa Homa viewed this moment as an opportunity, not confusion. For him, the inside bar after a breakout was the market's way of saying, "Wait, confirmation is coming." His approach was simple. He would enter once the inside bar breaks in the direction of the new trend. And look at what happened next. Once price broke above the inside bar, the market continued to move higher with strong momentum. Look at another chart example. Here the market is already trending upward, and you want to join the uptrend, but you're not sure when to enter. Muneisa Homa provided a great solution for this situation: the formation of the harami pattern, also known as the inside bar. As you can see, this is the first harami pattern. You can plan your entry after the breakout because the harami represents indecision and the breakout confirms that the trend is continuing. Then, notice the second harami pattern that forms shortly after. It gives you another opportunity to join the trend with confirmation. Now look at what happened next. Once those inside bars were broken, the market continued moving higher, perfectly in line with the dominant uptrend. Now that you understand the key candlestick patterns Munehisa Homa used, let's move to something much deeper, the system that combined them all, the Sakata 5 method. It's built on 5 core principles that describe how every market moves, from accumulation to trend, from exhaustion to reversal. Homa called these the 5 laws of Sakata, and they are San Zan. This is the origin of what we call the triple top. It signals that an uptrend is losing strength as the market fails 3 times to break higher. For Homa, this was the market's way of saying the climb is over. Look at this chart example. Here the market is trending upward, which means buyers are clearly in control. But then we can see the market forming 3 consecutive tops, the first top, the second top, and the third top. This is what Munehisa Homa called Sanzan, which literally means 3 mountains. Okay, according to Homa, this formation tells us that buyers have tried 3 times to push the market higher, but each attempt failed. It shows exhaustion, the point where bullish momentum starts to fade and sellers begin to take control. And look at what happened next. Just as Homa predicted, the market reversed after the third peak, confirming the Sanzan pattern. San-sen, the opposite of Sanzan. It's the triple bottom, a sign that a downtrend has reached exhaustion. When price forms 3 clear lows and fails to push lower, Homa saw it as the rebirth of buyers. The river has reached the sea and will flow no more downward. Look at this chart example. The market was moving down and then formed the first bottom, the second bottom, and the third bottom. This formation indicates that sellers are no longer able to keep pushing the market lower, which signals a potential trend reversal. For Munehisa Homa, this pattern, called San-sen or 3 rivers, was an early sign of a new uptrend and often used as an entry point to catch the beginning of a bullish move. And look at what happened next. As you can see, the market went up exactly as expected, confirming the San-sen pattern. Sanpei literally means 3 soldiers. It refers to 3 candles of the same color moving in one direction, showing strong continuation momentum. There are 2 variations. Sanpei Age, also known as the 3 rising soldiers pattern, consists of 3 consecutive strong bullish candles that appear after a decline, signaling either a bullish reversal or a continuation of the uptrend. Sanpei Sagaru, also known as the 3 falling soldiers, is a pattern made up of 3 consecutive strong bearish candles appearing after an uptrend, signaling either a bearish reversal or a continuation of the downtrend. Homa used this to confirm that a new trend was underway. When soldiers march in the same direction, the victory is near. Sanku, 3 gaps, represents market exhaustion. When the market forms 3 consecutive gaps in the same direction, it indicates that the move has become overextended. Homa warned traders to prepare for a reversal, saying, after the 3rd gap, the army runs out of breath. Sanpo is a continuation pattern. It appears when the market trends strongly, then pauses with a series of smaller candles such as inside bars or dojis, before continuing in the same direction. Homa used this formation to add to his positions, saying, the warrior rests, not retreats. What makes the Sakata 5 method so powerful is that it connects candlestick psychology with market structure. It teaches you when to enter, when to hold, and when to prepare for reversal, exactly how Homa built his fortune. Now let's move to the first trading strategy, where we'll combine the ancient wisdom of Munehisa Homa with modern market dynamics to build one of the most powerful and precise trading setups you can use today. In this strategy, we'll apply the second law of the Sakata 5 method, Sansen, which is the foundation of what we now call the triple bottom pattern. This principle shows us how the market exhausts its selling pressure and prepares for a complete shift in direction. To make this setup even stronger, we'll add one of Homa's most reliable candlestick signals, the Tsutsumi, or engulfing bar pattern, as our main confirmation candle for entry. And finally, we'll integrate a modern smart money concept, the liquidity sweep. This advanced confirmation tool helps us identify whether a reversal is genuine by showing that the market has first swept liquidity and trapped sellers before moving upward. This combination, Sansen, Tsutsumi, and liquidity sweep, bridges the timeless market psychology of the 18th century with today's institutional trading techniques. We'll be using this strategy on the 5-minute time frame for precise entries, while a higher time frame will be the 30-minute chart, giving us both structure and context. Let's get started. This is the US dollar, Canadian dollar 5-minute chart. The market was trending down, which means sellers were in control. Then the market formed the first bottom, the second bottom, and finally the third bottom. This is what Munehisa Homa called Sansen, the 3 rivers pattern. It's an early sign of a potential trend reversal and reveals the market psychology. Sellers are now struggling to keep the market moving lower. Next, let's apply one of our modern technical tools, support and resistance. As you can see, the market has touched this support level 3 times, making the structure even clearer. But we won't enter just yet. The markets have evolved and institutions are now active participants. We need more advanced confirmation before executing a trade. Now, look at what happens next. The market breaks below the Sansen structure but then closes back above the support level. This move is a textbook example of a sell-side liquidity sweep. Here, we combine Homa's ancient insight with modern smart money logic. The Sansen tells us sellers are losing strength. The liquidity sweep tells us large players have just triggered stop losses before pushing price higher. At this point, we can enter on the candle that closes above the support level. If you're a more conservative trader, you can wait for a candlestick confirmation. And right here we get it, a clear bullish engulfing bar confirming that buyers have taken control and that the market is likely to continue upward. Now let's do a quick top-down analysis. On the 30-minute chart, the market had been moving down, but it reached a major support level and rejected it sharply. Another strong sign of a possible trend reversal. That aligns perfectly with our setup on the 5-minute chart. Back on the 5-minute chart, here's how we'll execute the trade. Entry: at the close of the Tsutsumi candle. Stop loss, just below the liquidity sweep. Target: the next major resistance level. Now look at what happened next. The market moved up directly to our target, exactly as expected. I'm a big fan of the set and forget approach. Once you place your trade, close your laptop and let the market do its work. But if you prefer to monitor the trade, Homa also provided patterns that can reassure you. As you can see, after our entry, a Sanpei edge formed. This is one of the strongest signs of trend continuation. Another Sanpei appeared here and another one here. These repeated formations confirm that buyers remain in full control and that we made the right decision. Now let's move to the second trading strategy, which combines 3 powerful elements: Sanpei edge, Tonkachi, and the modern fair value gap concept. This strategy will be used on the 5-minute time frame, and it works across all markets: forex, crypto, and stocks. It perfectly blends Homa's ancient wisdom, which reveals market psychology, with modern order flow principles used by institutional traders today. Let's look at the setup. This is the New Zealand dollar US dollar 5-minute chart. As you can see, the market is clearly in an uptrend, moving in impulsive waves followed by retracements. An impulsive move, a pullback, another impulse, and another pullback. Here, we can identify 3 consecutive bullish candles, which form a clear Sanpei edge pattern. According to Munehisa Homa, this formation shows that buyers are dominant and that the market is likely to continue moving higher. Now within this Sanpei edge, there's also a modern concept at play, the fair value gap. We can spot one fair value gap inside the Sanpei edge pattern and another one slightly above it. But remember, we always focus on the last fair value gap during a move because it offers lower risk and stronger confirmation. Watch what happens next. The market pulls back, and once price reaches that final fair value gap, it gets rejected, forming a perfect Tonkachi candle. This candle tells us that sellers attempted to push the market down, but buyers stepped in and absorbed all selling pressure. For Homa, this was the market's way of saying the retracement is likely ending, and a new upward impulse is about to begin. If you understand fair value gaps, you know this Tonkachi is not random. It's a market response to the imbalance, which makes it a valid confirmation signal. Before taking the trade, let's check the higher time frame, the 30-minute chart. There we can see the market was trending upward, then consolidating, and recently broke out of that consolidation phase, starting a new bullish leg. This supports our 5-minute trade idea perfectly. Now back to the 5-minute chart. Here's how we execute the trade. Entry: at the close of the Tonkachi candle. Stop loss: just below the fair value gap. Target: the next key resistance level. And look at what happened next. The market moved exactly as expected, reaching our target with precision. This setup shows how combining Homa's ancient patterns like Sanpei edge and Tonkachi with modern concepts like liquidity and fair value gaps can create powerful, high-probability trading opportunities. If you learned something new, make sure to like, subscribe, and turn on the bell, because in the next video we'll go even deeper into smart money trading using Homa's principles. Thank you for watching and see you in the next video.